Hey, Devin Norcross here, Norcross Consulting Services. Wanted to take about 8 to 10 minutes to kind of bring you guys up to speed on what's going on with the new FICO 10 model. FHFA has now accepted that, so we will be seeing that as an accepted FICO model with Fannie and Freddie loans. I'm certain that we will see this adopted as an industry-wide acceptance over some time. So let's get into it real quickly here. Um, Again, I'm not gonna read this to you, but there's a little bit of justification of why these new FICO models and the VantageScore models are being accepted. It's been probably 20 years or close to 20 years since FICO had a new model accepted by the mortgage space. So this is a past due, change, I welcome it. So the first thing to just kind of bring everyone up to speed is, not sure who all is going to watch this video, is just the flow of information, right? As an individual, we apply for loans, we make those payments. Those payments are recorded by the creditor to the credit bureaus, and that's what the credit bureaus do. Is they are data collection firms. They are filing cabinets. All they report is our payment history and some of our personal history. As a lender, you have the ability to request just a data packet from the credit bureaus like you would right before you close a loan, or on the front side, you might request it with a scoring agency score. Fair as a Corporation, FICO, our largest scoring agency. There's another company called VantageScore, which is most commonly known. That's what Credit Karma uses. It's a joint effort by the three credit bureaus to take a bit of business away from FICO. These are scoring agencies, and when you pull credit or you have your credit pulled, that's done through an intermediary called a CRA. Anyone who's in the lending space will recognize a lot of these company names, probably worked with several of them. Your CRA is the one that's going to bring the new FICO model to you. Okay, it's not the credit bureaus that are going to select that. FICO comes out with new models about every 5 years, roughly. And if they get that model implemented in as many industries as they can, the more money they make. Every time a credit report's pulled and then they request to use that FICO model, FICO is going to get paid on it. The newer models they can charge more for. So when I started in the credit repair space, I would very often get asked, why are my clients getting different scores with different lenders? And the simple answer is I would look at a credit report and I would see different FICO scoring models. I would see Empirica, NextGen, and Classic 98. At the same time, I might see Beacon 5.0, Classic 04, and Fair Isaac version 2. And what that means is that some of the smaller, maybe more regional CRAs, they either couldn't afford or didn't want to pay FICO to use that new model. It has been so long since we had a model implemented in the mortgage space that everyone's on a level playing field. No one can go to KCB or Kroll or CoreLogic or Credit Plus and pull a higher credit score. We're all using Beacon 5.0, Classic 04, and Fair Isaac version 2. However, now that this FICO 10T model's out, FHFA says they'll accept it. Probably after we see, Fannie, Freddie, and HUD loans and things like that, say they'll accept it as well. The CRAs will start purchasing it, and then it might be that that when you pull through Kroll factual data, if they purchase the FICO 10T, you get it. Maybe it replaces one of the older bureaus. Maybe they purchased it for all three. Maybe it's an elective by your company as they sign up for it, similar to what a rapid rescore or what if simulator might be an elective. Some companies don't allow for that. You don't even see them on the credit report. This is the back-end peek at my FICO. This is a client, credit history, basically showing really to highlight the difference in score range based off you having the same credit bureau and different FICO score or FICO algorithms interpreting it. As you see here on the second line, it says commonly used in mortgage lending. This is a place where your client can get a true and accurate mortgage credit score in a soft pull format. I do use it frequently. But as we see here, FICO score 5, score 4, score 5, and score 2. Also as Beacon 5.0, Classic 04, and Fair Isaac version 2 are the main FICO mortgage models in play. Now you can get the 10T model through that site as well. I'll show you how they compare in a second. Now, why does FICO come out with new models, and why do we want these changes? So if we look at the changes between VantageScore's first attempt back in 2006 up to their current model of VantageScore 4.0 since 2017, and we can also overlay that with some of the changes between FICO from 2004 to more currently in 2014 and newer 2020 with the FICO 10 model. They're starting to play around with some different changes. So we see the big changes we see is they're starting to ignore paid medical collections. They're starting to ignore small dollar collections. And they're giving it several years to see how loan worthiness is impacted by these changes. So there's plenty of evidence now based off their newer models that things like small dollar medical collections and paid collections are not an indicator of loan worthiness. And that's why they're really taking them out of the risk model altogether. And then there's top-down pressure from the CFPB to address things like paid medical collections and small medical collections. So as of right now where we sit, no paid medical collection can report to the credit bureaus. And as of Q2 of 2023, any medical collection under $500 is no longer allowed to report to the credit report. I'm seeing two things happen from that. I'm seeing collections starting to be bundled and to appear like higher debts. And I'm seeing a reduction in collection agencies that are interested in settling debts. Collection agencies used to be very interested in settling debts. Now they they hold the power. Paid collections are going to get deleted. So if they ask you, hey, the end results that this gets removed, then we need to get payment or near to full payment on that. Sometimes they drop off the interest. That's 5-10% maybe if you're lucky. So moving forward, again, timeline here, FICO 8 came out in 2009. FICO 8 is basically a defunct algorithm, in my opinion. You don't see it. It's not used in any lending product for it per se. However, it is the free FICO score you get. So if you have a Mint app, if you have a credit card that gives you a FICO score, anytime my client tells me they know their FICO score, it's almost always the FICO 8 because it's so readily available. Again, it's not used in the lending space. FICO 9 and FICO 10, a little bit of FICO 9, not that FICO didn't really get that implemented too heavily either, but the 10T is the big one now. So what are we going to use in mortgage? In mortgage, we're going to use the FICO 10T. T is for trended data. They are going to judge people very heavily on the last 24 months of their behavior, not necessarily where things sit right now. So do you carry high credit card balances? Did you pay your credit card balance down a month before you went to apply for a loan? If so, your score is not going to be as favorable on the 10T as it is on the older models. The older models are only judge someone on their revolving utilization based off where it was at the last time it reported to the credit bureaus. This is very, very much looking at your 24-month behavior. A couple more things. They're going to change how they impact late payments. So a single late payment is actually going to have a reduction in impact, but multiple late payments are going to have an increase in impact. And I like that. I don't like seeing someone loses 150 points because they have one late payment. Another thing I like about it is they are going to increase the impact of installment loans. I think this one's huge. The current models are so heavily skewed towards revolving debt as interpreting loan worthiness that someone with a secured credit card could have a better credit score than someone with 10 mortgages and no credit card. So putting a better emphasis on installment loans and their payments, your student loans, your auto loans, your mortgage, I think is a tremendous step forward for everyone out there. Now, FICO does not award scores to all three bureaus. Currently, with the models we have, Beacon 5.0, Classical 4, and Fair Isaac version 2, if you are just turned 18, you had a bankruptcy, you just got your social, you're new to the country, you haven't borrowed in years, maybe you don't have credit scores. If that's the case, you're going to get your first credit score after you open an account and make your first payment. You're going to get your second credit score after you make your fourth payment, and you get your third credit score after you make your sixth payment. If you get added to someone else's card as an authorized user, that can jumpstart this. But largely, to get all three bureaus to report scores, you need to make 6 months payments and have those report to the bureaus. VantageScore is not that way. VantageScore will generate scores across all three bureaus immediately. The average client of mine over the last 10, 15 years that has a VantageScore 4.0 credit pull is about 40 points higher than their mortgage FICO score. The release says they're going to accept VantageScore 4.0. I think the entry-level metrics for these loans will have to change. I also don't think that there's a lot of lending institutions are going to have a lot of confidence in that VantageScore 4.0 just yet. I think FICO 10T will be much more palatable and probably the one that we see more readily. Now, FICO is estimating about 40 million people's scores to increase from this change, about 40 million people's scores to decrease. Okay, and around 120 million to remain unchanged. Now, here's an example of an individual on the exact same day. Their mortgage FICO 5, 4, and 2 model has a 766 mid score. At the same time, the FICO 10 model has an 817 mid score. This individual recently had an increase in their credit card balance. So the FICO 5, 4, and 2 is penalizing them for that increase in that credit card balance. FICO 10 is saying, well, we see the hit increase, but for the last 23 months, you've maintained low balances. We think it's fair to say that increase could be unlikely to remain high. So when do you see this in your computer? Again, your CRA has to purchase it. Your CRA has to have enough pressure from its clients, the mortgage institutions, that they want to see the 10T model. Right now, we just know FHFA will accept reports with that score. My estimate is 12 to 18 months. You start seeing this. It might be a time where a competitor of yours has the 10T model and you don't, and it doesn't mean that that's better or worse for your business. For a 640 and under crowd, credit score wise, I'm going to get a lot of opportunity to see how the 10T model impacts them over the more classic models. My anticipation is that they're going to be a little bit lower on these 10T models based off the fact they haven't had good 24-month trended data to base that off of. But we'll see. So that's what I have for you. If you have any questions, please let me know. Again, FICO 10 and 10T. 10T is the model we're going to see in the mortgage space. It's also very possible the VantageScore 4.0 comes in, but that would mean that the major CRAs are now working to buy the VantageScore algorithm. I just don't see that happening. I think that they're going to be very comfortable with their FICO relationship. So have a great day and talk to you soon.